Welcome back to the Wealth Effect, where we dive into strategies for building wealth, achieving financial independence, and mastering money. I'm your host, Green Moon, and today we're tackling one of the most powerful wealth building tools available, real estate. Now, let me ask you something. Why do so many people dream of financial independence, but never take the first step to get there? It's because they don't have a plan. They don't have a strategy when it comes to money. But today we're going to change that. We're going to lay out a roadmap so you can take action, build wealth, and secure your financial future through real estate. Real estate has created more millionaires than any other asset class. But is it really the golden ticket to wealth? Or is it just another overhyped investment strategy? Today, we're going to break it all down: strategies, risk, misconceptions, and how you can get started regardless of your financial situation. So, whether you're a first time investor, an experienced real estate pro, or just someone looking to understand how real estate fits into a wealth building strategy, this is an episode for you. Let's fill your pocket. Why real estate? First, let's talk about why real estate is such a powerful investment vehicle. Unlike stocks or bonds, real estate is a tangible asset. You can see it, touch it, improve it, and generate income from it. And unlike cash in the bank, real estate historically appreciates over time. But here's what really sets real estate apart: leverage. You don't need to pay the full price of a property up front. You can finance it with a mortgage, meaning you can control a large asset with relatively little money of your own. That's how smart investors scale quickly. And then there's cash flow, rental income. That's, if it's done right, can provide a steady passive income stream, but there's also tax advantages, appreciation, and equity buildup. So let's break down these one by one. But let me tell you something: real estate isn't magic. It requires knowledge, patience, and work. The three laws of real estate wealth. I'd like to say there are three laws of wealth building in real estate. If you understand these, you'll have a solid foundation to create lasting financial success. Law 1: the law of location. You've heard it before: location, location, location. But why? Because real estate isn't just about the property, it's about what's around the property. Is there demand? Are people moving in? Are jobs being created? A good property in a bad location is still a bad investment. You ever wonder why a shack in LA costs more than a mansion in the middle of nowhere? Because location is king. If people want to live there, prices go up. If the big attraction is a gas station with a world's biggest hot dog sign, maybe rethink your investment. You can't just buy a shack in the middle of nowhere and expect it to turn into a castle. But with the right knowledge, you can make some serious money. Law 2: the law of leverage. Real estate is unique because you can control a big asset with a small amount of money. Leverage is a tool. It can help build wealth or it can create problems. Use it wisely. Never overextend, meaning you don't get yourself into a property that's 10 times your salary just because they approved you for the amount. Make sure the cash flow supports the debt. Buying real estate with borrowed money is great until the market dips and suddenly your dream deal feels like a financial mess. Don't be that person who buys 5 properties with zero reserves and then panics when there's an economic squeeze. Law 3: the law of time. Wealth in real estate is built over time. The longer you hold, the more money you benefit from appreciation, rent increases, and mortgage paydown. The mistake: people often try to time the market instead of spending time in the market. Smart investors buy solid properties and hold them long enough to win no matter what. Get these 3 laws, and real estate becomes a wealth building machine. The 4 pillars of real estate. 1. Cash flow. The money left after paying all the expenses. This is what makes real estate a wealth building tool now and not just for the future. Pillar 2, appreciation. Over time, property values tend to increase, giving you long term gains. Maybe not today, maybe not tomorrow, but historically, real estate has been one of the greatest long term wealth creators. Appreciation can also be added by improving the property itself. Pillar 3, equity buildup. Your tenants are essentially paying off your mortgage, increasing your ownership stake in the property. Every month, your ownership stake in the property grows, and one day you'll be free and clear of the debt. Pillar 4, tax benefits. Depreciation, 1031 exchange, and deductibles on interest and expenses can save you thousands on your tax bill. Understanding these 4 pillars is key to making informed real estate decisions, but not all real estate investments are created equally. So let's talk about different strategies. There are multiple ways to invest in real estate, and choosing the right strategy depends on your goals, risk tolerance, financial situation, and your lifestyle. Let's go over some of the most common ones as well as some of their downfalls. Strategy 1, buy and hold. You purchase a property, rent it out, and hold it for the appreciation and passive income. This is great for long-term wealth building. The slow and steady way to build wealth. Passive income is great until you meet tenants who think no pets means they can bring their emotional support alligator into the bathroom. Optimizing rental income by improving property and increasing rents. 2, house hacking. This is when you live in one part of the multi-unit and rent the other units, allowing you to offset some of your housing costs. You better choose your tenants wisely, as they not only know where you live, but they can make your house a nightmare to be in. 3, short-term rentals, such as Airbnb. This can lead to a higher income potential, but comes with more management work and location restrictions. Strategy 4, fix and flip. Buying disastered properties, renovating them, and selling them for a profit is a high reward, high risk situation. Buying ugly houses, making them pretty, and selling them for a profit. Sounds fun, right? Until you realize construction workers don't believe in deadlines, and city permits move at the speed of a snail. Strategy 5, the BRRRR strategy, which stands for buy, rehab, rent, refinance, and repeat. A way to scale your portfolio quickly while minimizing your own capital investment. This is for people who love endless paperwork and dealing with contractors. Strategy 6, real estate syndicates and REITs. Passive investment opportunities for those who don't want to be hands-on. Investment in real estate without dealing with actual buildings for people who want real estate returns without ever stepping in a Home Depot. Strategy 7, commercial properties. Office spaces, rental buildings, industrial warehouses. They provide higher risks but greater rewards and often lease for a longer term. Bigger buildings, bigger paychecks, but also bigger headaches when your tenant's business tanks and they disappear overnight. Each strategy has its pros and cons. The key is to start one that matches your skill, time commitment, and risk tolerance. How to analyze a good deal. Success in real estate investing comes down to buying the right property at the right price. Before you start throwing cash at Zillow listings, let's talk about what you actually need. 1, location. A great property in a bad location is a bad investment. Look for areas with job growth, good schools, and low crime rate. 2, cash flow versus appreciation. Some investors prioritize monthly rental income, while others buy into appreciating areas for long-term value growth. 3, the 1% rule. A property should generate at least 1% of its purchase price in monthly rent to be a great investment for rental property. 4, expenses. Property taxes, insurance, maintenance, and potential vacancies should all be factored into your investment decision. Financing and leverage. Unless you're paying cash, you'll need to finance. Here are some of the main ways to fund your real estate deals. 1, conventional mortgages. These are traditional bank loans with competitive interest rates that last anywhere from 15 to 30 years. 2, Hard money loans. These are short-term, high-interest loans from private lenders, great for fix and flip investors. 3. FHA and VA loans. These are government-backed loans with low down payments for first-time homebuyers and veterans. 4. Seller financing. This is where the seller acts as a bank, letting you pay in installment payments rather than a lump sum upfront. 5. House hacking. Living in one unit of a multifamily property while renting out the others to cover your mortgage. 6. Utilizing 1031 exchanges. This main strategy is to defer taxes and scale up to a bigger property faster. 7. Leverage your equity. This is where you leverage your equity to acquire more properties at a greater scale, but does create the risk of losing each subsequent property. Overcoming roadblocks. Now let's talk about the most common fears and roadblocks that stop people from investing in real estate. 1. I don't have enough money. You don't need to be rich to invest in real estate. Strategies like house hacking, FHA loans, and partnerships can help you start with little money down. 2. What if I buy at the wrong time? Timing the market is nearly impossible. The best time to invest was 30 years ago. The second best time is now. Focus on buying the right property and not just buying at the perfect time. Then you don't sell, you hold, you cash flow, and you wait it out. 3. What if I get bad tenants? Tenant screening is critical. Running background checks, verifying income, and checking references can minimize this risk. You can screen them, you can make sure they have jobs, you can make sure they don't look like they're about to start a meth lab in your basement. 4. What if the market crashes? If you buy right with good cash flow and a solid financial cushion, you can ride out any downturn. Real estate is a long-term game. 5. I don't know where to start. You start by learning, and then you take action, because action is what separates the wealthy from the wishful. How to get started today. If you're listening and thinking, okay, I want in, but where do I start? This is a simple roadmap to get you started. 1. Educate yourself. Read books, listen to podcasts, and learn from experienced real estate investors. 2. Build your financial foundation. Improve your credit score, save for a down payment, and reduce any bad debt. Capital. While some strategies allow you to invest with little money down, having capital or financing options is key. Good credit. Lenders look at credit scores to determine eligibility. Interest rates and a good credit score can help you save money in the long term. 3. Choose your strategy. Decide whether you want to start house hacking, rentals, or another strategy. 4. Analyze properties. Learn how to calculate cash flow, ROI, and other expenses. 5. Network with other investors. Join local real estate meetups, find mentors, and learn from others. 6. Take action. Start small if needed, but start. Even a small rental property can change your financial trajectory because you don't need to get it perfect the first time. You just need to keep it going. The biggest mistakes new investors make. Now I've seen people win big in real estate and I've seen people lose everything because of real estate. Let's talk about some big mistakes to avoid. 1. Not doing the numbers. Hope is not a strategy. You need to run the numbers and make sure the property makes financial sense after all the expenses. If your financial plan is just hope and vibes, prepare to lose money. Run the numbers and run them again. 2. Ignoring market trends. Real estate isn't just about today, it's about where things are going. Pay attention to job growth, migration patterns, and economic shifts. If your town is known for having one job and that company is downsizing, maybe don't invest there. 3. Underestimating expenses. Repairs, vacancies, management fees, they all add up. If you don't plan for them, you'll find yourself in trouble. I'll cash flow 500 a month. Yeah, until your HVAC breaks or the roof leaks and your tenants decide to move out without a 2-week notice. 4. Not having an exit strategy. What happens if the market shifts? What happens if you need to sell it? Always have a backup plan. If the only way you make money is sell for more than I paid for, you're playing a dangerous game. 5. Over leveraging. Taking on too much debt can be dangerous when markets start to shift and you don't have a cushion to brace yourself with. 6. Emotional investing. Treat real estate like a business and not a passion project. The numbers need to make sense. Your childhood home probably isn't the best investment property. Try avoiding all these mistakes to have a better chance at financial success in real estate. Real estate investing is one of the most powerful wealth building tools available, but it requires knowledge, patience, and action. The key is to start where you are and grow from there. If this episode sparked your interest, take the next step. Read a book, attend a seminar, and start looking for properties in your area. And if you enjoyed today's episode, make sure to tune in to The Wealth Effect so you don't miss out on our next deep dive into other wealth building strategies.